Welcome to this episode of the Engineered Impact Podcast. I'm going to do something a little bit different today. I've got my whiteboard up, and I'm going to run some numbers for you. So, if you are normally listening to the audio version of the podcast, this is an episode you might want to catch on the YouTube channel. So, this week we've been talking about using cash value life insurance as a very powerful savings vehicle, and I've shared with you the reasons that kind of the key characteristics that any good savings vehicle should have, right? We've talked about liquidity, we've talked about safety. The two things that we have left that we want to talk about are getting a good rate of return on your savings and tax benefits. Okay. So today we're really going to dive into the numbers of why these policies are so powerful. Okay. So to start out, if you think about it, let's go back to the way most people save, right? They're either dumping money in a savings account where you're earning like 0.01%, right? Which effectively is zero. You're not going to get any growth, right? And that's typically something we're only going to do with money that we anticipate needing in a short period of time, right? Emergency savings and things like that. And then the other thing that most people do with their savings is they'll put it into a qualified retirement plan, an IRA, a 401k, something along those lines, right? So when the money goes in there, primarily, we're looking to make money as the value of the assets that we're holding, the stocks, the bonds, whatever we've got in there, to go up, right? If the price goes up, we win. If the price goes down, we lose, right? Now, there's probably some dividends in the mix there, but primarily, we're looking at, is the value of my assets going up or down, okay? Now, today is, I don't remember what the day is, but the Dow dropped like 1,800 points today, 7%, just out of the blue, right? It's been going up and up and up the last couple months since it dropped 30% earlier this year when the COVID panic started. And then today, again, the bottom just dropped out, 7%, right? Was it because coronaviruses are spiking or because the protests last week? Who knows? I don't know. I always get a kick out of the analysts on Wall Street that think they know, and every single day they publish why the market's doing what they're doing. But who knows, right? The bottom line is you don't really have any control over that. Some years you may get an awesome return, right? It may go up 20, 30%, and some years the bottom just falls out, right? So what I want to focus on today, and I've talked about this multiple times on the podcast, but today is where the rubber really meets the road, where we talk about how is your money growing in these policies and what can you do with it that makes it so much more powerful than something like a 401k where we're just putting our money in and hoping it goes up. Okay. So first off, when you put your money to work with the life insurance companies, we're working with mutual life insurance companies. And so when you open a whole life policy, you become a policy holder and an owner of the company. Okay. So when you open this policy, they're going to give you a guaranteed rate of return that's 3 to 4%. Okay. Generally, on my policies, it's about 4%. Okay. And then because you're a part owner of the company, you are going to share in the profitability of the company. And so there's a non-guaranteed dividend that these companies will issue. It is non-guaranteed, but they've issued them pretty much every year for like a century. So it's as close to a guaranteed non-guarantee as you can get. Okay. So on average, what I've found is that the policy is growing between 4 and 5% every year, depending on what that dividend ends up being. Okay. So let's say you've got $25,000 in a policy. Okay. So you open your policy, put $25,000 in there. Okay. Now at 4%, let's be conservative. That's going to be $1,000 a year in interest that you'll earn. Okay. Let's pretend there was no dividend. All right. So just sitting there, $1,000 a year. Okay. Now that doesn't sound like a lot. 4% doesn't sound terribly impressive, right? When you talk about the stock market, a lot of times they'll promise 8 to 12%. Once you factor in taxes, that's more like 5%, right? But then you're going to have the years where you lose 30%, or the 2008s where you lose 60%, right? So over time, earning 4%, what ends up happening is you actually earn compound interest, okay? And I've talked about before what happens when you interrupt a compounding curve, okay? If you look at a compound curve, it's slow at first and then it peaks, right? as time passes, it starts to skyrocket and it turns into the eighth wonder of the world, right? But anytime that curve gets interrupted, you reset it, and it takes longer to hit that knee in the curve. Okay. And that's what happens when the market drops 30% or 20% in a year, is it interrupts that compounding curve, and it pushes out the knee to where it takes longer to get that super growth, right? Okay. So to me, I would rather earn a guaranteed 4 or 5% over time, because I can actually bank on what that compounding is going to look like. Okay. So that's the first thing, is sitting in this policy. If you never did anything with it other than let it sit there, it's going to grow at 4 to 5%. Okay. Now that's not a ton, but it's respectable. Okay. That will beat inflation, which on average lately has been kind of on the order of 2 to 3% a year. Okay. So you'll at least stay ahead of inflation and grow a little bit. Okay. But as I've shared before, where these policies really become powerful is in your contractual ability to borrow against the cash value in your policy. Okay. Now, when you take out a loan, you're not actually taking money out of your policy. What you're doing is you're taking a loan from the insurance company, and they're using your policy as collateral. Okay. So because no money is leaving my policy, I'm going to continue to earn $1,000 a year on that $25,000. Okay. And that's going to compound, right? The next year I'm going to earn 4% on 26,000, and so on. Okay. So the loans do not impact, they do not interrupt my compounding. That's the first thing to understand. Okay. So contrast of something like a 401k, you can take a loan against a 401k, but that money comes directly out of your account. The interest that you pay does go back to your account, but it does interrupt the compounding process. Okay. So that's the first thing to understand, is when I borrow against it, I don't lose out on any growth. It doesn't impact my interest payments. Okay. So what would you do with this? Okay. Now, as I shared yesterday, you can borrow against these policies for any reason that you want. Okay. But my favorite reason to do it is to invest somewhere else, because if I can be earning 4 or 5% of my policy, and then I can go get a second rate of return on another asset, that's going to help me go faster, right? That's going to help me achieve my goal of financial freedom in 10 years or less. Okay. So let's look at what that might look like. Okay. Now you can invest in anything you wanted with that money, right? You could go buy cryptocurrency with it. You could go buy stocks. You could buy bonds, mutual funds, whatever, right? But my favorite thing to do with it is buy cash flowing real estate. And today I'm gonna do kind of an example for you and show you why this is so powerful. Okay. So let's say that we are gonna buy a house that's gonna cost $100,000. Okay. And if you're thinking to yourself, Dan, there's nowhere in the world where you can still buy a house for $100,000, I have done this multiple times. Okay, this is a very realistic example. Okay, now when I do that, what I'm going to do is I can get an 80% loan from the bank. Okay, so I'm going to go to the bank, and they are going to give me $80,000 to go buy this property. Okay, so what I'm going to do is I'm going to take a $25,000 policy loan from the insurance company. Okay. That will generally be at about a 5% interest rate. Okay. Which year one, to make the math easy, we'll just approximate as a straight 5%, $1,250. Okay. This is my cost of that capital in year one, $1,250. Okay. So effectively what I'm doing is I'm financing 100% of this house. Okay. There's no money coming out of my pocket to go buy this $100,000 house. The insurance company is going to give me 25. The bank's going to give me 80. Okay. So what I'm going to do is I'm going to bring 20,000 as a down payment, and the other 5 will go to closing costs and reserves. Okay. So there's my 25K. Okay. That 25K is going to cost me $1,250 in year one. Okay. Now let's assume that the mortgage is also at 5%. Okay. So my mortgage payment is going to be about $430 a month. Okay. And the way that's going to break down, and this is just principal and interest. Okay. We'll talk about insurance and taxes later. Okay, so about $330 of that per month will be interest that I'll pay to the bank. Okay, and about $100 a month is equity. Okay, that's going to pay down that $80,000. Okay, now what can I expect when I buy this house? Okay, when I buy a property, I'm looking to buy in an area where rents are about 1% of the purchase price of the home. So on a $100,000 home, I would be looking for rent of at least $1,000 a month. Okay, which is $12,000 a year, right? Okay, so of that, I'm going to assume that my expenses are going to be about 40%. Okay, I'm going to say $400 per month goes to expenses, $4,800 a year. Okay, now that's everything from homeowners insurance, property taxes, tree branch fell on the roof, refrigerator broke, tenant skipped town, whatever, right? I'm just going to assume 40% over the long term owning this property, 40% of my rents are just going to go to cover all those expenses. Okay, I'm just going to write that off. So that's $4,800 a year. Okay, now on top of that, if you remember from right up above, we are going to pay the bank interest of $330 per month, which is also coming out of our pocket, which is $39.60 per year. Okay, and we also have equity of $100 a month. Okay, now this is still coming out of my pocket. This is coming out of my 12 grand a year, but this is also making me wealthier, right? Because this is effectively money I keep. Right? I'm paying down the principal on that loan, and that equity now becomes mine. Okay, so when I do all this, what am I left over with? Okay, so if I start with $12,000 a year in rents, I subtract out my 40% in expenses, I subtract out the almost $4,000 I'm going to pay to the bank in interest, and then I subtract out the $1,200 I'm going to pay to the bank that goes to pay down the principal on my loan. What I'm left with is $2,040. Okay, now what that $2,040 represents is my cash flow on the property. Okay, that is $2,040 that I get to go put in my pocket. Okay, now if I compare that $2,040 to the $25,000 that I had to bring to the table, that is an 8.2% cash on cash return. Okay, so right there, I mean, that's more than double the 4% I'm already getting on that $25,000 that's sitting in my policy, right? 8.2%. That's pretty good, but we're not done. Okay, because I also am going to take credit for that $1,200 in equity that's effectively going in my pocket every year. Okay, which adds another 4.8% to my return. Okay, so if I'm doing my math right, that puts me up to 13% that I can pretty much bank on. Okay, but the other thing is, what do we know about real estate prices? Over time, they generally go up, right? Just like stocks. Okay, now I don't buy property banking on the appreciation because I have no control over that. Okay, it's just a trend that over time tends to happen, right? And it tends to happen at about the rate of inflation. Okay, but let's be super conservative. Let's say it appreciates at 1% a year instead of the 2 to 3% that inflation typically averages. Okay, so 1% of $100,000 property is $1,000 a year, right? So if I add that $1,000, that's an extra 4%. Okay, so if I add all that up, that is $4,240 per year that I'm effectively putting back in my pocket based on an initial investment of $25,000. Okay, that I took out of my policy. Okay, now what is that real rate of return? Okay, so if I just add up the returns on the individual pieces, I'm looking at 17%. Okay. So 17% of that $25,000 I took out, I'm putting back in my pocket. That's a heck of a return. Okay. And if I can do that year after year after year, that is incredible. Okay. But that's not the full story. Okay. If you remember a few episodes back, when I started talking about the perfect savings account, I talked about what a bank does with your money. Okay. And I gave an example of how a bank earning 5% on a car loan and paying me 0.01% on my savings could generate a 49,900% return on money that I put up, right? They could take $10,000 that I saved, go loan it to somebody else, and earn a 49,900% return while paying me 0.01%. Okay. Now, if it's not clear yet, effectively what I'm doing with these policies is building my own bank. Okay. I talked yesterday about trying to be like the bank. Okay. If banking is the most profitable business in the world, let's go learn how they do it and do whatever we can to try and mimic that. Okay. So that's exactly what's happening right here, right? I'm borrowing money from the insurance company, just like the bank borrows money from me when I deposit money into a checking or savings account, right? The bank is effectively borrowing my money. Okay. In this instance, we can borrow from the insurance company. We're using their money, not ours. Okay. And when we do that, the cost of that is 5%. Okay. If I go back up here, I have to pay the insurance company $1,250 a month for the privilege of accessing $25,000 of their money. Okay. But if I can take that money and generate $4,240, what is the real return on that? Okay. And so if I look at the $4,240 that I earned and the $1,250, which was the cost of that return to me, I actually generated an annual rate of return of 240%. Okay. Now think about what that would do to your retirement planning. Okay. If you could generate 240% on your money every year, how fast could you hit financial freedom? How fast would you be ready to retire? Okay. This is awesome. Okay. I love this. When I first saw this, when one of my mentors first walked me through this, I was blown away. And I went home and I had to walk through this myself because I didn't believe it because it just sounded too good to be true. Okay. But not only have I now run the numbers, I'm doing this in real life. Okay. Everything I've shared here, to me, these are very conservative estimates. Okay. And again, if you're thinking you can't do that, $100,000 house, you can't do that. You can do that. Okay. You may not be able to do that in your hometown. I can't do that in my hometown, but there are parts of the country where this is totally possible. Okay. So what I hope you're taking away from this is you can be a bank. All right. Now, I don't have a way for you to generate a 49,900% return. Okay. But if I can generate 240% a year on the capital that I'm borrowing from somebody else, that's pretty sweet. To me, that's a pretty good deal. Okay. And not only am I generating that kind of return, but I've got my money working for me in two places at the same time. Okay. I've still got that $1,000 a year that the policy's kicking out that's not factored into this at all. Okay. And I've got my money working for me in two places. And now I have two assets, right? I've got the insurance policy that is backed by their 100+ years of keeping their commitments to their policyholders, that my money's sitting there 100% backed by very safe assets that the company is buying, the insurance company is buying. And at the same time, I've now leveraged the capital I put into that policy using the insurance company's money to buy a second asset, okay, a piece of real estate that is going to generate cash flow for me all year, every year, okay, that has a tenant that's paying down my mortgage for me, that's appreciating and taking advantage of whatever the housing market is doing. And it's a real tangible asset, right? This is something that the government can inflate into oblivion. And we haven't even talked about taxes, right? I didn't factor into this the fact that this $4,240 of income is tax-free, okay? So this is very, very powerful. I hope you're starting to see how you can leverage these policies to act like a bank and to start to see the kind of profitability that a bank is getting, not the same magnitude, but the same kind of techniques that they're using to amplify their returns, you can do using these policies, okay? You can generate real cash that's going into your pocket, right? The policy is generating $1,000 real cash that goes into your pocket. The house is generating over $2,000 of real cash that goes into your pocket, okay? And the equity and appreciation, although that's not real cash, it's real asset that you get to take advantage of, right? Someday, I'm going to take advantage of this $1,200 a month or $1,200 a year that somebody else is paying down in principal. I'm going to go do a cash out refinance from that, and that will be real cash that goes in my pocket, right? Same with the appreciation. Someday, I'm going to take advantage of that, and that will turn into real cash that goes in my pocket. Okay, so what I want you to take away from this today is these policies allow you to start acting like a bank, okay? They are not only very safe, your money is not only very liquid and accessible anytime you want it, but you can use these to generate incredible returns and diversify your assets into multiple streams of cash flow, okay? And this is only doing this once, right? Imagine if you did this. What if you took that $2,000 in cash flow and used that to pay back the policy loan to the insurance company? As soon as you had another $25,000 built up, you went and you bought a second house, right? Well, now I've got $4,000 of cash flow I'm putting in my pocket. I've got $2,400 of equity every year. I've got $2,000 of appreciation every year. Just imagine how that starts to spiral, okay? So this is powerful. I absolutely love this, and I would absolutely encourage you to explore this further. Okay, so that's what I have for you today. I will catch you next time.